D company is a public listed company. It has been considering the accounting treatment of its intangible assets. Okay. And how the matters below should be treated in its financial statements for the year 31st March 2014. First, on 1st October 13, D company acquired T company. Mhm. Acquired T company, a small company that specializes in pharmaceutical drug research and development. The purchase consideration was by way of a share exchange and valued at $35 million. Okay. Hmm. So, what do we call it? Purchase consideration. Purchase consideration is 35 million. Right. The fair value of T company's net assets was 15 million. Fair value of assets acquired is 15 million USD dollars, excluding any items referred to below. Okay. Excluding any items that they are going to talk down below. T company owns a patent. Okay. For an established successful drug that has a remaining life of 8 years. So T company's patent, we can say useful life is 8 years. Firm of specialist advisors, L company, has estimated the current value of this patent to be 10 million. Estimated price or value of patent is $10 million. All right. However, the company is awaiting the outcome of clinical trials where the drug has been tested to treat a different illness. If the trials are successful, the value of the drug is then estimated to be $15 million. Okay, so once it's become feasible, its price will be, um, we can say once successful, it will be of 15 million. Also included in the company's statement of financial position is $2 million of medical research that has been conducted by our client. Okay, medical research. So they have done some research of $2 million. So these are the facts in this first question, first pointer. Then in the second pointer, the company has developed and patented a new drug. Maybe we can write it here for easiness sake. Okay. D company has developed and patented a new drug. So we can say new patent which has been approved for clinical use. Okay. The cost of developing the drug was $12 million. Based on early assessment of its sales success, L company have estimated the market value. So new patent cost and new patent, what do we call it? Market value. Hmm, It is 20 million. Now, in the third pointer, what they are saying, uh, D company's manufacturing facilities have recently received a favorable inspection by government medical scientists. Okay. As a result of this, the company has been granted an exclusive 5-year license. Okay, so they have a 5-year license to manufacture and distribute a new vaccine. Although the license had no direct cost to D company, its directors feel its granting is a reflection of the company's standing and have asked L company to value the license. They have placed a value of 10 million. Okay, 5-year license value, they are saying it is 10 million. Okay. No direct cost involved as such, but they're estimating its value to be 10 million. The fourth pointer. In the current accounting period, D company has spent 3 million sending its staff on specialist training courses. Okay. So we can say that it is employee trainings. Employee training is 3 million. All right. Sending its staff on specialist training courses. While these courses have been expensive, they have led to a marked improvement in production quality, and staff now need less supervision. This in turn has led to an increase in revenue and cost reductions. The directions of D company believe these benefits will continue for at least 3 years and wish to treat the training cost, so its benefit will be of 3 years. Okay. All right, so these are the facts, and then they are asking question. In the first pointer, they talked about some acquisition. In the second one, they talked about some patent cost, and then they in the third pointer they talked about this license value, and then in the fourth they talked about employee trainings, and they will get the benefit over 3 years. Now, question number 62. Identify whether each of the following items should be capitalized as an intangible asset or recognized as an expense. Okay, whether it will be capitalized or recognized as an expense. So first one, they are saying patent for the new drug. Hmm. Patent. I don't think I need to type in here. So it's saying patent for the new drug. Okay. So, hmm. So the cost was 12 million, and they said that. So let's read it again. D company has developed and patented a new drug which has been approved for. So because it is approved for clinical use, it can be capitalized. Okay. Hmm, because it is feasible now, so it can be capitalized. It is tested for clinical use, so it's okay. License for the new vaccine. It should also be capitalized because it is they have got this license. Okay, in this third pointer, um, exclusive 5 year license. So it's they can they have got this license, although no expenditure, although the license had no direct cost. What are the options? Either want to capitalize or expense. So it will be capitalized because they have license for 5 year, so the benefit will be over 5 years. So every year it will be amortized. So initially it will be capitalized. Specialist training courses undertaken by D staff. So this employee trainings are like expensed off. Okay. So this will be expense. And then we have the fourth one. T company's patent on the existing drug currently. Okay, T companies. Okay. The company that they had acquired, So they had acquired this patent. I think this is related to the first pointer, although they have kept it at the fourth place. What was the fact there that the purchase consideration was this fair value of assets was 15 million. They have patent useful life of 8 years. Estimated value of the patent was 10 million, and then once it becomes successful, it will be 15 million. And then they did some medical research. So based on these facts, this should also be capitalized. There is nothing that suggests it should be expensed off. And we have just two options, either to capitalize or to expense. They should be our answers. Now, 63. Select which two of the following are required if, let's do it here. Yeah. Select which two of the following are required if D company adopts the revaluation model for the measurement of its intangible assets. Okay. So if they require this revaluation model to measure the intangible assets, what do we need? The entire class of intangible assets must be revalued at the same time. Valid active market for the asset can be used at initial recognition of the assets if there is an active market. The asset may include cost of prepaid marketing expense and training cost. Okay. So first one is the right one. The entire class of intangible assets must be revalued at the same time. So first one will take. And then there should also be a valid active market, you know, to be able to use a revaluation model, because on initial recognition, the original cost of the item must be used. It cannot be used from initial recognition. Hmm. Is that? But if they are switching to revaluation model, um, you know, um, there has to be an active market. So the question was which two of the following are required if D company adopts the revaluation model for the measurement. So there has to be a valid market and the entire class of intangible assets must be revalued. Okay. All right. What is the 64th? It's also looks no maths needed here also. Should be quick. IS 38 intangible assets gives examples of activities that would be regarded as research and therefore not eligible for recognition as an intangible asset. Mhm. IS 38 intangible assets gives examples of activities that would be regarded as research and therefore not eligible for recognition as an intangible asset. So research will not be recognized as an intangible asset. So which of the following would be an example of research activities? Okay. Out of these four, which of the following would be an example? So there has to be just one right answer. First, the design and construction of chosen alternative products or so the design is the design and construction of chosen alternative products or processes are research activities. The design of pre-production prototypes and models are those research activities. The design of possible new or improved product or process alternatives. The design, construction, and operation of a pilot plant. So this is the keyword here. The design of possible. So it is possible. You know. So or improved product or process alternatives. So this word possible itself suggests that it is kind of research activity. Hmm. Because this shows that this activity is still at the research stage. All other like first, third, and fourth suggest that it's chosen or it's approved, but this second one, third one, the design, because it says the design of possible. I will stop here only. I will not write any after this itself suggests me that it is not a final and hence it is a research activity. Okay, so third should be the answer. Okay, third one will be the answer. At what amount should the patent acquired from tree company valued at? Okay, so the patent that they were talking about, so what should be the price that they have uh, done this thing? All right, so this is going to be a little, I mean, some calculation will be needed. Here they have this estimated value of the patent was 10 million. Okay. But there are some periods required here because this period in this, what is the question, they're asking about 31st March 14. And if you look at the date, on 1st October 13, they acquired it. Okay. So it is for 3 months, I mean 6 months. Okay. So it is 10 months, 10 million. So what happens is when we acquired it, maybe we can do this maths here only, or maybe we can just bring this thing here about this patent, this 65. We can paste it here. So take up it useful life is 8 years. Estimate value of the patent is 10 million. But this was acquired on 1st October. So on this 1st October, its value is 10 million. Okay. This date I will keep it here. But they are asking about this 31st March 14. So 6 months we have. So for 6 months, it's 10 million. because useful life is 8. So yearly amortization is 1.25, but we will further divide it by 2, because the period is 6 months only from 1st October to 31st this thing. So out of 10 million, we will deduct this amortization for 6 months. So 9.375. So option 2 will be the answer. Okay, which is 9375000. Okay. Hmm, I will change this thing. Yep. Then 66, which is the last one in this set of questions. What are they asking here? No maths needed here also. Should be quick. How should D company treat the goodwill arising on its acquisition of T company? Okay. It should be capitalized and amortized over 20 years. It should be capitalized and reviewed for impairment. It should be capitalized and reviewed for impairment every 5 years. Every year, it should be written off to retained earnings. There are five options. So when we acquired, when we do acquisition, so IAS 36, impairment of assets, it requires that goodwill will be tested for impairment on annual basis. Whether there is an indication of impairment or not, as per IAS 36, goodwill has to be so one thing is sure, it will be capitalized, but it will be reviewed for impairment every year, right? So option 2 will be this thing, that goodwill will be capitalized and then review for impairment every every year. Okay, IS 36 talks about it. All right, so we are done with this set of questions.